Hi, this is Mike Maloney, and a few days ago I came across an article on David Stockman's Contra Corner, a three-ring circus, Wall Street, Washington, and central banks. And he says, stocks are up again. Whoa! Hold on just a cotton-picking minute. Honest investors are getting out of the stock market. There have been net withdrawals of $80 billion from U.S. equity funds so far this year. So who's buying? And he shows equity fund outflows, and this is a speculator's market, and the number one gambler is playing with an infinite amount of chips. We're talking about central banks who create money on demand. He's talking about currency, not money. Now, alarmed by Brexit and the worldwide slowdown, they're buying assets at the fastest pace since 2013. Just look at the chart below from Citi Research. As you can see, central bank issued liquidity tracks the stock market almost perfectly. And he's got a chart here of central bank liquidity versus global stocks. So this is global liquidity versus global stocks. Now, I've been showing a chart very similar to what the point that this chart is trying to get across for some time now, just based on the U.S. But what you see here, every time they create currency, the stock market goes up, and there is a very, very high correlation here. So the chart that I have been showing, though, is from the St. Louis Federal Reserve, and it's the monetary base, so base currency, how many paper dollars there are, and the Wilshire 5000 Total Market Cap Index. And what you see here is a correlation that is absolutely astounding. Again, they almost match each other perfectly. There's only a couple of times where they get a little bit out of sync, but otherwise, this correlation is so tight that there's absolutely no possibility that this is an accident. I've shown this many, many times. But what I want to show you right now is that the divergence here between where base currency stands and where the stock market stands is the highest that it's been since this whole manipulated market started back in 2009, with the crash of 2008. This, the divergence, the difference between these two, the spread. Once we got to where Janet Yellen started doing the tapering, they diverged, but every once in a while, the Wilshire 5000, the stock market, falls to meet the base currency here. It's done that a couple of times. And if it does it again, it means that when it does it, the stock market will be in for a much bigger plunge than we've seen the past couple of times, because base currency is falling. So thank you very much for listening. If you found anything about this interesting, please like it and share it. And if you could, subscribe to our channel. Thank you very much. We'll see you next time. This video was brought to you by goldsilver.com. I'm proud to say we've been one of the most trusted dealers for over a decade now. We have fast, free shipping and a price match guarantee. While our competitors serve you ads, we serve you education. And that's the difference with goldsilver.com. To learn more, click the info button. Thanks.